You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, you know what that theme music means. It's time once again for Volatility Views, the premier program for volatility traders. My name is Mark Longo from the OptionsInsider.com, as well as from the ever exciting Options Insider Radio Network. We have a legion of programs for you to choose from on the network. If you fall on the basic end of the spectrum, well, then by all means, check out Options Bootcamp and Options Playbook Radio, the latter of those two, a short 15-minute weekly check-in and update on some fun option strategies you may want to use in your portfolio. Of course, if you're more on the active retail side of the fence, well then, the Option Block is the program for you. Of course, if you're into volatility, well, you're already listening to this show, so you're doing the right thing. If you're a financial advisor or perhaps looking for a financial advisor who may want to add some options functionality to your portfolio, you want to know what they should bring to the table, well, then the Advisor's Option is the program for you. If you like futures options, well, we got two of those for you, long and short of futures options with the CME, as well as the Futures Options Roundtable. So two choices for you there, and we're looking to add more because so many of you are asking about futures and commodity-oriented options content. And of course, we have our tech show for those of you who are hardcore into the tech side of the space. And if you wanted some daily news rundowns, well, then check out our Options News Rundown for all the breaking news from that day in the world of options. Lots of cool stuff. I'm sure I'm forgetting a couple. Oh, yes, our interview show. Don't forget our flagship interview show. It's my version of Charlie Rose, where I get to sit down with all the different movers and shakers in the world of derivatives and pick their brains a little bit. All kinds of fun stuff on the old network. And where can you find all that stuff? Well, of course, you find it on the website, you find it on iTunes, but probably the easiest place these days to find it all in one place is our mobile app available for iOS, Android, even the burgeoning Fire OS. So you can, of course, instantly stream all of your favorite episodes of Volatility Views, and then maybe you download a few for some offline listening later on, and while you're doing that, you say, hey, I don't really agree with those guys over there, or I really agree with them, or maybe I have a question about what they're talking about on the show. Well, you hit that email, hit that feedback tab, and you can shoot us a Facebook question, a tweet, you can shoot us an email, even leave us a voicemail, all directly through the app. Really cool stuff. Check it out. The Options Insider Radio Network mobile app. I think you're going to like it. All right. And joining me on the old Volatility Views panel this week, he hasn't been on in a while, so we're happy to welcome back none other than Mr. Andrew Giovinazzi from OptionPit.com. Mr. G, welcome back to the program, sir.
It's always good to be on the Vol Views. Volatility with a view, as I call it.
That is our tagline, sir.
I love it. What a tagline.
Indeed. It has served us well all of these many, many years. And I do believe we are also joined from scenic and suburban Virginia by none other than Mr. Jared Woodard from BGC Partners. Jared, welcome back to the program, sir.
Oh, I'm always happy to be here. How's it going today?
It is going well. We actually have some volatility to discuss, and not just in VIX land, but across the board, which is always kind of fun. Like to expand our purview here whenever possible, and certainly the commodities seem to be leading the charge when it comes to vol this week. But I think we'll save the rest of that ammunition for the old volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, welcome to the Volatility Review. This is, of course, the portion of the show where we break down the week that was from a volatility perspective. We'll start, as we always do, in the realm of S&P implied volatility, aka the VIX, and then we'll broaden our horizons a little bit into some of those funkier products. I think we'll kick things off looking back at the week that was from a good old VIX cash perspective. It was a bit of a sell-off week. And, it seems like the narrative almost shifted during the week. We've been talking on this show for quite some time about how the broad media and the financial media in particular tends to view volatility and tends to view the VIX, and they've been beating this drum forever that the VIX was quote-unquote too low and that it had to mean revert back to 20. We've debunked that multiple times here on the show and espoused our own opinions on the subject. And it seems like after last week, when we finally closed south of the 11 handle yet again and then penetrated well into the 10 range this week, it seemed like, for whatever reason, that was the catalyst. And all of a sudden, we started to hear a little bit of a different drumbeat, that people started pontificating in certain outlets and it started getting picked up elsewhere, that we might actually have a chance of seeing a single-digit VIX, which, if I recall, Mr. Giovinazzi, was something you prognosticated way back at our year-end show, I believe, on either Volatility Views or perhaps on the option block. So perhaps if that doesn't come to pass, then you get pride of place for predicting a single-digit VIX first. How does that feel, sir?
I'm going to get so excited I might go out and fish.
That's the main way to celebrate, is it?
It is. I've actually, Mark and I were talking about, what was the VIX before there was VIX, like 93, 94. What was the VIX? It would have been 7 or 8. So I think Jared probably wasn't born yet. But like in the early 90s, as an SPX trader, 13 vol was at the money, was a huge sale. So, where VIX is, I think there's a little bit of I think it's a mode reverting, like I love that 20 VIX number. I don't think, I think it's a little, people don't quite understand exactly how that 20 gets. I don't know if that's something we're going to cover on the show today.
Oh, we've trodden that path many times, sir. The debatable long-term average of 20.
Yes, and how that 20 actually comes to be, it's just that how big the shocks are relative to how much time it spends just poking around in the nowhereville. So, just keep all those things in mind as you move forward and you load up on those 14 level calls in VIX next week. Just be mindful of the fact that we could spend a little time here.
So I was thinking about this, about the average level in VIX, and Andrew hits it on the head. You can, if you run as an exercise, you can take out, let's say 2008 from your data set, or take out 2010, 2011. Some of those spikes that we weren't seeing in the 90s quite as much, for instance, and try to simulate what would implied vol be like during a relatively mild period in the economy, where you have some stable growth or some mild conditions. And in those kind of situations, 20 just looks radically high, and these low teens, even lower, is absolutely normal. And so I think that people are so conditioned to and have such an imprint of the financial crisis and the sovereign debt crises still kind of in the back of their minds that's kind of anchoring, I think, expectations even years and years afterwards as to what's normal. And I think that it's going to take still some time for once monetary policy normalizes, I think that'll send a signal that might inspire some confidence and help people sort of move along psychologically. But until we have that sort of more normal feeling and we see some stable, positive GDP supporting all of that, I think that people just are anchored to those crises and those crisis periods, and I think that's informing a lot of these ideas.
Yeah, we tend to forget sometimes here because we've been in the choir for so long here. We've all been cognizant of VIX for so long, but the better part of the investing public and the broad financial media as well, the bulk of them really awakened to this product post 2008. And so they have a very different frame of reference than you or I might have, or someone who's been trading the product for any extended period of time or looking at the data. We had this conversation a little bit on the option block yesterday, and there was extended periods in the 80s. Of course, that's all extrapolated data, but if you extrapolate that data back, we were in that 7 to 8 range for an extended period of time. So when you think about it in that context, and like we've said many times on this show in the past, that number of 20 just becomes increasingly absurd once you really start looking at the data. So, of course, moving away from the VIX cash for a second into some of the actually tradable products, we saw some activity this week in VIX options, including an interesting spread going up today. I'll get to that in a little bit. Of course, VIX options still lighting up the tape, not as strong as they have been perhaps in recent months, but still doing about 611,000 or so ADV, which is sizable for any product out there. I think most options products would kill to have that number of ADV. Call put getting a little bit heavy again to the call side. It had drifted down, was threatening to cross that 3 threshold, now back up to the 3.3 range. I guess that's probably going to get even heavier as the VIX continues to drift lower because, again, like we said many times, the paucity of strikes to the downside versus the upside is going to weight that indicator ever more heavily towards the call side of the fence. Speaking of call activity, we did see just before the show, actually, when we were prepping for the show, pretty sizable call spread going up out there in VIX today. It was the July 14-18. At the time we looked at it initially, it went up about 2 big blocks, really. It looks like about almost just a hair shy of 40,000 contracts. Went up for 37 cents. It was mid-market, so I have to dig a little more to see if it was indeed buying or selling. A total of 60,000 going up on those strikes on the day, so it looks like more piled in after the fact. Kind of hard to dig in as well because, like you'd imagine, with any near at the money strike in VIX, size open interest on both sides of that trade, about 145,000 and 171,000 respectively on those two strikes. So I don't know if you caught that one in your daily perusal of unusual activity there, Andrew, but it was a pretty interesting size vertical going up there in VIX.
It was just, again, hard. It was a tough one to figure out. I mean, they've written this down for so long. I want to say like they're closing it. They're just catching a little pop and vol and they're closing it. That would be my inclination, but because we had such a drawdown this week from like the mid 12 handle to here and 10.5. We saw the low yesterday morning right on the opening for at least for the vol futures. They've come up a little since then, but it feels like it's closing, but who knows? Because there's 170,000 contracts open on the 14 strike.
Yeah, a product's pretty active when even a 40 or 60,000 lot spread can get lost in the noise on a strike.
It's lost in the noise.
That's an active product. Any other product, that would be it. That would be all of the volume. And yet that's just the activity on one strike. So that shows you how active VIX can be on any given day there, listener. Speaking of the other strikes that are active out there, a lot of people, surprisingly, all this talk about VIX being call heavy, when you start looking at the actual strikes that are seeing activity, the number one strike this week is the July 13 put. I can't remember the last time we had a put in the top spot from an open interest perspective out there in VIX, doing over 400,000 contracts on that strike, 416,000 open. Talking about noise, you could do a couple 100,000 lot spread on that strike and you wouldn't even see it. Then the July 16s, nearly 400,000. They have about 385,000. The calls, of course. July 20 calls, 371,000. And bringing up the rear there, the SEP 19 calls, 261,000. I believe that was part of that sizable spread we saw go up about a month ago. So the puts taking the lead this week.
You know what? This is one of our better vol trading weeks. It doesn't surprise me because there was some serious future premium, and you had the Fed minutes coming out, the FOMC meeting minutes coming out, which is still good for a vol crush every now and then. So, people loading up on those things for the move down made some sense. People selling the 13 puts, I don't know if that's going to work for them. I mean, really at this point, we're waiting for earnings unless something really happens in Iraq. I mean, anything can happen, but that's kind of what we're going to get here with this. The market's just kind of poking around. I mean, we're we still are at the point where we are looking for things to go wrong instead of things to go right. As far as, and when all of that financial literature changes every night, we'll know that the market is due for a fall because everybody is still looking for something to go wrong. But that's why I think those 13 puts were so busy. I think this because people were closing. They bought them for little tiny dollars and they end up becoming big dollars. So then I think they're going to be, they're going to be worth probably a lot more than $1 in another week or so, probably by Wednesday.
Moving on out to the other top of mind VIX product out there these days is, of course, the VXST options. These are the short-term products. Still trying to find their footing out there. Certainly not lighting up the tape the way the mothership VIX product does, the way we just described it, how much open interest that product has, how much ADV. That thing is just lighting up the tape any given day. VXXT, not so much, doing about 600 contracts a day nearly these days, so it's getting up there a little bit stronger, a little bit more robust than it has been. About 3,200 open interest on the product, which has come off a little bit in recent weeks. Heavy call to put, which is what you expect from any VIX product. That's the primary use case, which is again why those puts in the mothership VIX was so interesting. 2-to-1 calls to puts out here in VXST. Again, not much paper really, so it's kind of hard to read anything into those tea leaves. And then the top most active strikes out there in VXST was the June week 4s, the 16 calls, about 700 open on that strike, and then about 600 of the July week 1, 18 calls. So use that for what you will there. Not a heck of a lot really to parse yet in VXST land. I think all of us are still really waiting for that product to start lighting it up. And, I think the last couple of weeks, you'd think that VXST would be a useful thing, particularly a couple of weeks ago going into the non-farms. That would be an ideal use case for VXST, yet we didn't see anyone really adopting the product in that fashion. So we'll wait and see perhaps if another event can come down the pike that really will kickstart VXST and get some volume out there. And then last but not least, looking at the other VIX-related product, of course, RVX. This is the Russell Volatility Index. Open interest still hovering around 5,000 contracts out there, and the ADV still pretty much roughly about the same as we saw last time. All that open interest still pretty much open. Haven't seen too many large additional size players coming in since the last time we parsed this product. Probably also waiting for some ETPs to get listed on RVX before we really start to see some serious volume out in that product as well. Of course, the disparity we saw in recent weeks between RVX and the VIX caused some interesting spread opportunities out there, and undoubtedly that was what was driving some of the paper that we saw lighting up the tape out there in RVX over the past couple of weeks. We'll have to see if that spread can materialize again and create some of those same opportunities. Jared, we've discussed many times on the show in the past how the Fed and indeed the broad economic data here really relates back into the realm of implied volatility. It's one of the big drivers of this volatility, quote-unquote, malaise that we're in right now. And the headlines coming out of this week was that Yellen seemed to have single-handedly torpedoed market volatility yet again when she came out and said that essentially the inflation data that she was looking at was quote-unquote noisy. And you have to love how the market can just hang on any single word from the Fed chief. And this particular word, noisy, really got a lot of people up in arms because it seemed to come maybe as a little bit of a counterpoint to what some of the data had actually been suggesting to people ahead of that. And of course, if the Fed's not going to take a lot of action, well, it looks like volatility may be in this malaise period for longer than some people anticipated. Was that your takeaway from the Fed meeting this week as well?
I did pay attention to that. I think that it's notable that some of the critics were pointing to measures like CPI, which are by definition, by construction even, noisier than personal consumption expenditures and some of the other metrics that people watch. So some of this is, I think, arguing about definitions more than anything else, rather than about substance. But even beside the inflation point, there were a couple of things notable that we were really watching. There were a couple questions during the Q&A that I think were important. There was a remark about financial stability and whether the Fed might be, thinking of some kind of a policy response in order to support financial stability as a kind of a, it's kind of a third mandate that sometimes people talk about. And I thought that Yellen's response to that question was really notable. She said that, that they, of course, pay attention to the amount of leverage in the system, to what's going on in high yield and leverage loan markets, but that so far there wasn't any evidence of enough leverage or enough maturity transformation taking place to warrant significant concern. And so she concluded that no, there's no policy response expected for now, for the sake of financial stability. And that relates directly into the other big question that I think was on everyone's minds. I think it was John Helsenrath who asked about the complacency question. Is market volatility too low? And Yellen responded, we don't have a volatility target for financial markets. We do have targets for leverage and for stability. But again, absent any evidence of too much risk taking or excessive leverage, there's not really any reason to think that this is such a big issue. She even mentioned, I don't know that complacency or too much exuberance is what's driving low volatility right now, which you can take as just a denial on her part, a kind of withholding of assent from that idea. But I think, and this is a little bit of interpretation, but there's a sense in which middle America politeness would lead to someone to say, I don't know that that's the cause. In other words, that's absolutely not the cause, of what we're seeing right now. So in that kind of context, my read was that, she was really not interested in fueling that kind of speculation. If anything, seeing continued growth in financial assets is supportive of the Fed's policy all along of getting people to, come out of their shells, start taking a little bit more risk, start, taking a chance on the economy. And all of her comments this week were consistent with that theme.
Yes, you could probably count on one hand the number of times I've heard Fed chairmen in recent history actually discussing volatility. So that in and of itself was pretty interesting. It was also insightful to the fact that they really don't care what the VIX is doing. They don't care what realized or implied vol out there is doing. Their metrics are elsewhere, and they know what their actions at the end of the day will have some impact on that realm, but that's not their primary focus. Some may argue that's good, some may argue that's bad, depends which side of the fence you fall on. But still interesting to hear her kind of outright dismissing their impact on volatility, at least in the near term. Some people out there pontificating on this as well. An analyst from Morgan Stanley putting together a note saying the Fed's characterization of recent inflation readings as, quote, noisy, and the preponderance of evidence to the contrary leave us feeling as if the Fed is likely to dismiss most economic data deviations from slower moving trend processes under this, quote, dismissive framework. I love how they have to label everything. Implied market volatility should increase less for a given economic surprise than under our previous framework, a, quote, reactive framework, based on the idea that the Fed would be more data dependent. As a result, we turn neutral on implied volatility. I mean, that's something we've been saying on this show for a while. We've been, not bearish and perhaps not bullish, but kind of mildly neutral here on vol as well. It seems like perhaps maybe post Yellen now, the rest of the world is finally waking up to that fact.
When the Fed gets out of the economy, there is going to, and I know that sounds strange, but I believe just historically, there's just less volatility because when they need to get in, those moves they make tend to be big, either supporting things when it's ugly or trying to, juice the economy one way or the other. When they're out, who in there is going to wait, start throwing around, who's going to be the 800-pound gorilla throwing around the trillions of bucks worth as a stimulus. So to me, that makes the market a little less volatile. And that's how markets have really behaved for, most of the last couple hundred years. You get volatility when something bad happens and the government has to start stepping in and doing stuff, which starts freaking everybody out. So the more they have to pull, the better things are.
And, just looking at the broader perspective, I know a lot of our listeners like the data, they like the charts, they like the analysis, and people are always asking, now that the VIX is again in this sub-11 handle range, in fact, as we're recording this today, Friday, June 20th, listeners, the VIX cash hovering just south of 11, 10.94. People asking, when was the last time we were in this range, when VIX was in this, 10.5 to 11 type range? And it was actually back in February 23rd of 2007. And if you recall back then, and you probably don't, the S&P at that time was at 1451. And the VIX closed that day at 10.58. So gives you a little bit of historical frame of reference because people are going to read into that how they will. And, look what happened later on in that year and the subsequent years. And perhaps this means we're poised for some big calamitous event in the broad market. But still interesting to see just from an historical perspective when the last time was that we actually flirted with these levels. All right, moving on from VIX and broad economy volatility into the realms that really were lighting up the tape this past week. And we'll start off with gold. It's kind of funny when we were prepping these show notes. Sometimes we start a couple days early to get a handle on all the myriad shows we have on the network. And the narrative going into the initial version of these show notes was that, hey, gold volatility yet again at its lowest level since 2010. And if you looked at what was going on earlier this week, the gold vol again hit a 44-month low. That was right before the Federal Reserve meeting. It dropped to 11.4. That's, of course, the 60-day historical. It hadn't hit that level since October of 2010. Gold futures were also in a range of about $45 this month, compared with $74 back just a few months ago. So gold clearly less volatile than it was. And that was going to be the narrative going into today's show. Then, of course, the events in Iraq happened and some other developments started gold volatility, at least, on a tear. We saw GVZ jump nearly 20% in a single trading session. So a lot going on out in the realm of gold volatility. So it kind of makes us wonder now going forward if perhaps this is the catalyst people have been waiting for to finally get a spark of life going on from a vol perspective out there in GLD and in the gold futures.
You know what? I'm still trying to figure out what yesterday was with that jump in gold. I mean, they were pricing at the money gold move like a little more than 1% for 2 weeks. Like 3 days ago, which it moved a lot more than that. Yeah. So I'm of the mind that this is kind of a blip. It feels like somebody was just some shorts closing, something like that. Again, what are the drivers as like I said again, as the Fed pulls out, what are the drivers? You know, the Europeans don't seem like they're doing a whole lot with the stimulus thing. They mostly talk about it, but they don't really seem to do tons. So I think gold will kind of settle at some lower volatility than it is right now, to be honest.
Yeah, I heard kind of similar things yesterday, that there may have been a hedge fund or two that had some big short positions they had to get out of, that they liquidated as kind of exacerbating that move. I did notice that the upside skew in GLD options moved noticeably as a result of yesterday's change. So the at the money, lifted as well, but you definitely saw the call skew increase. And, from a contrarian basis, that might be something worth considering for a trade. But otherwise, I mean, I don't know. I always come back to the fundamental issue with gold, which is that, it doesn't generate dividends or doesn't buy itself back. And so it's hard to know what the fundamental drivers are of the price of gold. So it's hard to have a fundamental view to start from. And so it all kind of seems like positioning to me sometimes. But at the very least for a trade, yeah, it's hard to imagine this kind of move, continuing.
Yeah, we're already seeing gold vol coming off into today's trading session. And looking at GVZ today, listeners, which is, of course, the implied vol out there in GLD, coming off quite a bit, coming off over 10%. I know that drives you crazy, Andrew, 1%, but c'est la vie. I shall adopt the convention used elsewhere. Trading around just shy of 13. Of course, it gapped up substantially yesterday. All of that pretty much coming off. I would say there would be some interesting trading opportunities out here in GVZ if this product actually traded, but it does not. I won't get too much more into that because I know we have a listener question about that a little bit later, but still an intriguing landscape, and I tend to lean towards your side of the fence there, Jared, that it looks like some sort of aberrant position was responsible, and adjusting, removing of that was responsible for this move, because otherwise it seems like all other indicators are pretty much the same for what we're seeing out there in gold land, at least for the time being. And looking on some other commodities that have also had some volatility returning to them of late. Of course, we talked a little bit last week about oil. Oil continues to be in flux with these Iraqi dissidents moving ever southward and all the other turmoil that results from that. We saw vol swinging back in to the oil markets. Historical vol in the Brent crude climbed above the 11% level. That's from a low, that was an extreme low actually, of south of 9%, actually about 8.6% back in just a couple of weeks ago, back in June 6th. So seeing some actual realized vol emerging out there in the old Brent crude markets. Looking here at a chart of Brent crude historical volatility over the past 6 months or so, and we're still at the low end of this trough. We have gapped up to just shy of the 12 handle, but just earlier this year in January, we were in the 17 range. from a realized vol perspective. It dipped down in the February range, right around the 12 level again, so close to where we are now. But then, of course, the Ukrainian crisis hit, and we saw it spiking up yet again into the March timeframe, well above the 16 handle from a realized vol perspective. So we still, if this crisis continues, we still have a ways to go to the upside in terms of realized vol. We're looking at right now at the August Brent crude out there on ICE. It was slightly higher. Had come off a little bit off the levels we discussed last week, trading right now right around 113.57. All right, maybe Mr. Jared, we'll start with you. What's your take on this resurgence of vol, pun intended, out there in oil land?
Well, yeah, so we're seeing both Brent and WTI options on the futures priced in the mid to high teens. I kind of thought that this might be a one-off kind of event, that there'd be a spike in implied vol, it would calm back down, and people would kind of trade it quietly until the situation either got demonstrably worse or just kind of faded away. I saw coverage this week that was talking about how the supply crude oil kind of focused areas of the country had significant defenses, and that they were going to be much more difficult to control and to access than some of the residential places that ISIS has already invaded. And so for that reason, the threat to the crude oil supply was probably not as great as it might have seemed at first. But nevertheless, we're seeing this big bid in the option premium, and so I think there's probably, if there's anywhere that's tradable for people who are looking to take some risk, who are tired of equities, this has to be the place. But at the same time, I'd be hesitant to take a big position without some pretty savvy analysis of the situation. Because as you know, if you get a big supply disruption, there's plenty more upside to go.
I'm with you, Jared. I was of the mindset last week that this was going to be another kind of aberrant move, kind of like what we saw in gold. That was going to be a bit of a spike and just start coming off, and that would be pretty much the end of it. And yet what we're seeing is the resiliency of the vol out there is kind of surprising. It's undoubtedly due to the fact that Obama is sending the 300 to Iraq, and now that he's banding about that number of military advisors, that's got to be worth at least a point or two from a vol perspective. Mr. Andrew, what's your take on what's going on out there in Iraq?
Well, I would have preferred helicopter gunships.
Yeah, that'll be good for a few vol points too, I would imagine.
But usually when we send the troops and the vol goes down, historically every time. I remember distinctly in 91, like my fourth day on the floor or something like that, just watching the volatility collapse and the Dow went up like 100 points, which at the time I think was like a 3% move or something like that, which set off probably the lowest volatility in the last 30 years over that spring. But normally when the U.S. does land, vol comes in, and now they've got guys there to direct in case things get worse, because I don't think as Iraq, I think they can kind of box it off. It's as if it spills over into, the problem is Iraq is close to Saudi Arabia. It is close to Kuwait. It is close to Iran. So it's a very touchy spot. And I think that's the reason why oil continues to just slowly grind up, because the nature of volatility, and in this place, it would be the nature of the price of oil, it's going to continue to rise until there's a reason for it to go down. Because who are the natural sellers of, let's say, upside in oil? Are they the major oil companies? So it's only the people that have the stuff that they can deliver. So what happens in a case when volatility starts to get what I would say fractured, even though the at-the-money volatility is pretty low, but the skew is definitely getting a little higher. And the path of least resistance for oil right now is still up. Until there's resolution, it's going to keep going up. It's not going to go up a lot until something bad happens, but it's going to continue to grind higher because that's how volatility tends to trade. So, you don't want to short oil until something happens, and then there'll probably be enough room on the downside where it'll still move down a little farther. So I thought the best trade here was probably to buy some out of the money put spreads of longer duration, and you just wait it out, put time spreads, something like that. You can get them for tiny money, and they can end up being something worthwhile down the road. So, but if you're gonna wait for anything to happen this week, that's not going to happen unless you've got a couple of stealth bombers going in there and just surgically removing all these guys from wherever they are. So, and I don't think that's going to happen because it has not happened in the last 5 years. So.
And you're talking, just to clarify, you're talking tiny put spreads in WTI or the ICE Brent, not in USO, right?
Well, the thing is, USO is a crappy product, but it's actually good for the way down. So if you buy if you're looking at, let's say, 37 put spreads or 36 put spreads, time spreads, in that sort of realm, it works good. It works well. It probably would work better in the more direct future products, but you also have a little bit more noise from it's harder to time spread in a future option product because you do have the vagaries of the underlyings there. So the USO, it might be a little more simple for the retail that, if they want to try to fade this oil move, it is good for a move down to 36 or something like that, wherever it was where oil started. I think that was right around the level before all this hullabaloo came into play. It was trading, like 36.5 before all this started. So you're looking at 36, 36.5 put time spreads, probably 3 months out. And you just let the market drift down until this thing goes over. You don't want to lay out too much money on this, so that way you don't, if you get that sharp gap, you'll be, you don't want that. So spend little dollars, and then as time goes on and oil drops, those time spreads should be worth a little bit more money.
Yes, good old USO, predictably crappy, predictably garbage.
You got to stay with the predictably crappy part.
All right, and then we'll wrap up here. In the realm of currencies, narrative there this week, the same as it has been in previous weeks as well. Currencies pretty much still remaining at or near record lows. It's come up a little bit, but nothing really appreciable. The Deutsche Bank gauge of currency volatility, it was at 5.51 this week. That's, of course, bouncing off the essentially record low it sent last week of 5.28. That was the lowest data point on record going back to 2001, which I believe is the inception of the index. So last week it really hit some record lows, and they're still hovering around those levels. And not a heck of a lot really to show that vol is going to be returning anytime soon to any of the currencies. So not a heck of a lot out there to really parse. Jared, anything catching your eye from a currency vol perspective this week?
I keep coming back to this question of where we're going to see the first meaningful uptick in volatility, both realized or implied, doesn't matter, because you do have this convergence of the asset classes over the last 6 to 12 months, which is pretty unusual, where you've got equity, currency, commodity, and rates all moving lower. And my kind of just a gut intuition is that you're going to see a change in the rates and currency side of things first before it filters through to other assets. So in that respect, I feel like at some point, owning vols in these currencies is going to be a good trade, but it still hasn't been for a long time. Even in the euro, it's been a trade the last 12 months really, where every time there's a meeting, there's heavy speculation about some kind of a change in policy. People bid up all that gamma at the money, and it just never pans out to anything. And that was never more true than the last ECB meeting. There's another one coming up in July, which I think is also near non-farm payrolls, if not mistaken. So you'll probably see another big bid for vols ahead of that session. And if the future is at all like the recent past, it's not going to pan out to mean anything at all. A good friend of mine was complaining this week that he's been pitching some of these long vol trades in currencies, over the last couple months, and they just keep kind of going the other way. They keep going ever lower, even though it just seems like the most intuitive thing in the world that they'd revert higher at some point, whether it's the yen or the euro, any of the G10s really. But if I had to get out somewhere, if I had to be a little bit more cautious, I guess I'd be inclined to pull back in rates and currencies here.
Yeah, perhaps not the best time to be advocating on behalf of some long vol strategies out in currency land, unless you want to keep rolling for quite the foreseeable future. We talk about carrying cost out there in the VIX on a regular basis, but same deal out there in currency vol land as well. So factor that into your models if you're looking at or advocating on behalf of some long vol currency trades right now, because you may be holding on to those for a wee bit. All right, and now it's time for us to keep on rolling right on into our next segment. It's time to open up the Volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the Volatility voicemail. Make your voice heard by dialing 779-669-4VOL, posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, everybody. Like the man said, no shortage of ways for you guys to get in touch with us here and make your questions, your comments, your insight known here on the old program, just like your fellow listeners did today, starting off with Mr. or perhaps Mrs. J. Ingram. They write, "Loved the discussion of GVZ on the network this week. I'm very intrigued by this product. Like Mark said, GLD and VIX should be two great tastes that taste great together, yet this product does no appreciable volume. I've tried to trade this several times, but the lack of volume and terrible spreads has kept me out of it. Why do you think GVZ has essentially failed as a trading product?" This is a great question, Mr. or Mrs. Ingram. This goes back to something we were saying on some of the other shows on the network this week, pontificating after that big move in GVZ, looking at what was going on out there. And again, the lack of volume out there. Some days you're doing 6, 8, 10 contracts out in GVZ from an options perspective. We had one big day this week when the big move happened. We saw, I think, 160 contracts go up. And that was a heavy day. It was essentially an 80-lot risk reversal. And that was pretty much it from a volume perspective. So yeah, that product, it would seem on paper, theoretically, to be combining two of the hottest things going, GLD and VIX. Those two things should be a home run. And yet, for a variety of reasons, it seems to have not caught on. I know some of the early problems with it stem back to the underlying. There is indeed that GV future on the CBOE futures exchange. That in and of itself doesn't really light up the tape either from a volume perspective. So when your underlying isn't really widely adopted by a lot of people, that's probably not going to feed a lot of volume back into the main product itself from an options perspective. But in general, it seemed like the initial issues seem to stem from problems with the underlying. I'm not sure if they've really ever rectified that. Andrew, I know you look at GVZ every now and then as well. Was that your take as well? Is that some of it stemmed from the underlying and it kind of just hamstrung this product from the outset?
Yeah, I'm still trying to, without an underlying product, it's just very difficult to trade. When you have a derivative product, you need an underlying. So I think that's the whole problem. I mean, the OEX, at least from the beginning, had a basket. So a professional, back in the old days, right, when you were trading, when the OEX first was the only index product, you could trade a basket of stocks against it. There was something that you could do to replicate the underlying. And, if without an underlying, you might as well take the product and say, forget it. It's just a waste of time. That's my opinion, just because I don't see how you have a derivative without an underlying. But, maybe I'm just old like that.
There is this GV future. It doesn't really do anything, but it does exist.
But it's not trading, right?
I don't see any appreciable volume going up anywhere. Right. So underlying does exist. I just don't know if or when it's ever really going to start trading, and that, of course, would kick it off.
Well, because it definitely had that underlying. So maybe now I confuse myself, because I thought that this underlying I just don't see a trade anywhere.
Yeah, that's the thing. But I am looking right here at the gold ETF volatility index security futures contract specs on the CBOE futures exchange. So the product exists. Why it doesn't trade may be a whole other story, but it does exist. It says it was listed in March of 2011, and it goes into all the specs here. Contract trading hours, 8:30 to 3 p.m. Chicago time.
Oh, it's there.
I think I traded those one time.
You're the one.
Yeah. No, seriously, when I had when I was managing those CTA accounts, I'm pretty sure that we executed some stuff in those gold futures, those gold vol futures. Although it may have been, the part of the problem was that the CME group listed some commodity vol products around the same time. And that really, whatever natural demand there was, which is probably the root issue anyway, not enough natural demand for the product, whatever there was probably split between the CFE and the CME products. And so, it's too confusing to try to figure out, it's like VHS and Betamax. You don't know which one's going to win, or that's kind of dated. A Blu-ray and I don't know, but you've got to have some natural demand for the product, and B, a unified market where it can at least get some traction before you start diversifying into similar listings. And neither of those things really happened, I think, with gold. I mean, think about the marginal buyer of gold. Is that person likely to want to hedge volatility in gold? Well, no, right? Who owns gold? It's, from my understanding, people who respond to commercials on television, people who, for cultural and other reasons in East Asia, own gold, and some central banks, I guess, occasionally. None of those owners has a natural demand to want to hedge gold volatility, and so you have to kind of work harder to find a natural market for the product. And I'm just not sure that one has existed yet.
I think those are all great points. You're right. There was this licensing agreement and deal with the CME that I'm sure whatever demand did exist was bifurcated between those products. And I think Mr. or Mrs. Ingraham, I think our own confusion here on the show about the existence of the actual future should give you some indication of how little popularity and how little actual value this thing actually has in the marketplace. I think Jared said he may have traded it once. So there you go, listeners. You're right. It does theoretically on paper sound like a home run. And yet, like so often is the case in the derivative space, we just saw it with the minis recently, a product that on paper should be a home run. Once it hits the marketplace, the devil's in the details, and the way it's implemented can really undermine that. We saw that with the minis, and looks like that's the case here as well, unfortunately, with GVZ. Great question. And you could tell from the tone of the questions this week that gold vol is on everybody's mind. Next up, we have a question from Cigar Store Indian. I like that handle. He writes, "Great show. Thanks for breaking down the problems with volatility ETFs like VXX. I've dumped that product from my portfolio after listening to your program. Thanks for helping me dodge a bullet on that one. I also have a question about another ETF product, GLD. This product doesn't seem to have the same issues with regards to term structure. Am I correct in the estimation that this product is safe to buy and hold in my portfolio for longer than a few hours?" Well, another good question here, Mr. Cigar Store Indian. You're right. We spent a lot of time debunking the big ETPs like VXX and others that just get crushed from a roll risk perspective. Like I said before, anywhere from 5 to 14% a month on average for those products just getting crushed from roll risk due to that contango we have out there in the volatility futures term structure. A different beast, as you correctly noted here, with GLD. And the reason for that primarily is that they hold the physical. And they hold the physical in some vaults, I believe, out in London. There's some controversy over whether they hold enough physical and all that other stuff out there. But essentially, this product is they gather up a bunch of bullion and they issue shares on it on a regular basis. So when you actually have the physical, you don't have to worry as much about the nuances and vagaries of the term structure in your futures because you've got some physical item stored up in a warehouse somewhere. It'd be analogous to if you could go out and buy barrels or bushels of VIX and put it in a warehouse. Then you wouldn't be dependent as much on the futures term structure out there, but that's not the case. Whereas in GLD, that is the case.
Yeah, I mean, it seems to track gold really well. The price of gold, I've held it for a while in a portfolio instead of buying gold, although my wife's like, I want the coins. She
wants to put them under her pillow.
She okay, if we're going to buy gold, I want a box of jingly stuff and just put it away, and then we'll have it in case, it all comes tumbling down. So in that case, it is not quite as comforting as the jingly gold stuff, but it does seem to track the price of gold well.
I will say, if you want to go down a rabbit hole of conspiracy and paranoia, then start digging into the GLD and their physical holdings and how well they manage them or not. There are a lot of interesting viewpoints on there for some afternoon reading there, listeners. But at the end of the day, that is the reason why GLD isn't impacted negatively from things like term structure, where other products like the VIX ETPs are. So great question there, Mr. Cigar Store Indian. Glad we can help you dodge that bullet with VXX. Unfortunately, that's all the time we have for the volatility voicemail. let's dive into really quick the crystal ball segment.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, listeners, you know the drill by now. This is, of course, the portion of the show where we pontificate on what may happen from a vol perspective in the week to come. And maybe we'll mix it up a little bit this week, guys, because it doesn't look like there's a heck of a lot going on out here in VIX land for the foreseeable future. So perhaps we'll mix it up, get where the action is, and we'll start pontificating into the commodity realm first. And then maybe if you want to drift into VIX, we can do that as well. So maybe, Jared, we'll start with you. What do you think is coming down the pike over there? It could be oil, could be gold, could be somewhere else. And then we'll wrap it up with VIX vol.
Gold. Let's try fading the gold volatility. I can't imagine this move that we saw continuing. Just looking intraday, as you said, Mark, at the top of the show, some of the premiums already been sucked out of there. So without more confirmation, we have to look at this as most likely a one-off event. And so from the volatility perspective, I think the bias there is to be short. In crude oil, I think we covered it really expertly today. And that, there's too much uncertainty around the situation to have a strong view. If you've got, political risk analysts in your stable who can give an informed view, then that's good. But, without that, and given the strength in implied vol in oil lately, I'd be a little bit cautious about taking too contrarian a view, leaning with a short bias there. In equity volatility, we talked about this as the pain trade, I think, one or two shows ago, and I think that continues. It sure hurts to be short equity index premium these days. Everyone's unhappy about that, but that's also being short gamma anyways. The only thing that's really been working in a meaningful way in the volatility space, and I think that's got to continue until either data or maybe a few months down the road a Fed change prompts otherwise. The one thing we didn't talk about at the top of the show that I'm keeping an eye on is the exit tools that the Fed has created for getting back to normalized monetary policy. We won't get into the details here, but the reverse repo program and the term deposit facility, I think, are going to be extremely important. Maybe 1 or 2 quarters from now, and those could. It's not clear how well those are going to work. They could misfire. There could be some missteps, and even if they do work as intended, the effects are not going to be clear. And so those are things that are going to be really important to watch that could cause some significant movement in the market. And I think that's a legitimate concern. But until then, it's hard to see what would be a catalyst. And so I think you have to lean with a short bias in equity indexes still.
Well said, sir. Mr. Giovinazzi, anything to add to that?
Short bias involved, yes. It blew through my short-term downside target already. So, maybe we see 10.5 next week. To me, any move up in vol is 100% what goes on in the Middle East. The financial markets have totally taken themselves out of it. The Fed has made the clear path, all that kind of stuff. At least for the next week or two, it's all Iraq, and then it's whatever happens this weekend. If nothing happens this weekend, and the 300 are, I'm sure those guys know what they're doing, and they will direct. The problem is if they're directing U.S. gunships, it would be effective. Maybe directing the Iraqi gunships, maybe not so effective. But if that situation does calm down at all, you will see the VIX probably break the 10 handle next week.
I love it. I just have images of Leonidas marching on Iraq. With all the numbers to throw around out there, the 300, that's such a loaded number. That's surely that symbolism was not lost on them in Washington. All right, that's all the time we have for the Crystal Ball segments. Also all the time we have for this episode of Volatility Views. But before we go, as always, I like to check in with each of my cohorts here on the old panels, listeners, see what they have cooking that may interest you. Until the next time we can all gather together here on the old program. Jared, I think we'll start with you. What's coming down the pike over there at BGC Partners?
Well, we've got our regular research, I should say strategy publications coming out. We've been doing some one-off notes and ideas lately. I wrote up a nice, or I thought it was nice anyway, a piece of coverage on the Fed meeting this week. And I'm working on a longer-term or recurring publication, I should say, that's going to look at more single stocks and volatility in single names I think there's a lot of interest in that these days as the indexes have quieted down. So that's something people can look forward to in the coming weeks.
And Mr. Andrew, wrap us up. What's coming on the pike over there at the pit?
I believe on the 28th, the day before my birthday of June, Option Pit will be doing a risk management, trading management seminar. It costs money. Go to optionpit.com under events. Doesn't cost a ton of money, but we will go through, managing positions when things get stinky, like we're in a low vol environment again. So you want to think a couple of moves ahead. So we will be doing Mark did a hit on Fox Business News about managing stop orders. Got a lot of response for our little website. So we will do basically a 2-hour webinar on helping people, manage option positions. So that will be next Saturday. Go to optionpit.com//events and sign up. And if you sign up, we'll always find a way for you to take those dollars and put it into some other Option Pit services like our chat, which actually is adding about a person or two every day. So it's going much better than we thought, actually. So it's very satisfying over there at Option Pit right now.
Good stuff. Always fun to chat like we do here on this program. And unfortunately, listeners, that is all the time we have to chat this week. So on behalf of Jared and Andrew, and of course myself, I want to thank all of you in the listening audience for downloading and streaming and subscribing to our little volatility chat fest here. And of course, for sending in such great questions. Keep them coming. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.
I was just looking for gold futures.
The great quest for all of us.
That's what I'm like. Where are they? I haven't seen.
On Bloomberg, the symbol's VXIU for some reason.
Is that a CFE handle?
Yeah, I got that from the specs page.
Yeah, I mean, you guys see the specs page. I'm not smoking crack. It exists.
No, I'm looking at it, but I only see settlements in 2011. I mean, I know I could swear there was a VIX or gold future,
I'm on
but it just doesn't trade.
There's a page, quote vendor symbols for GV, for the GVZ security futures, and it's got, Bloomberg, CQG, a couple other vendor quotes.
I love it that we're all just completely befuddled
in the middle of the show.
Whether this product exists.
Well, I tried to look at the CFE website and I could just search gold futures, and I can't get even a latent quote for off the website.
Okay, Bloomberg says the September contract for the gold volatility futures has traded volume of 6 today.
Ah, there you go.
There you go.
Lighten up the tape.
Right. Sorry, it trades. It trades.
So there.
There you go.
Okay.
Take that. Eat your 6 contracts, sir.
I feel better, though. I thought I was imagining having traded those.
He was so befuddled, he dropped off Skype. He was so outraged at that 6 contracts of value.